my first real investment property that I was never going to live in, Columbia, South Carolina in 2019.
The moment that you realize that you can start getting paid for something that you're not actively managing is a really good feeling.
The biggest benefit to that loan was the fact that they were willing to commit additional dollars.
All of the deals that we've done are around the $1 million mark, honestly.
You have to be very humble and aware of all the stuff that you don't know.
All right, everyone. On today's show, we have Mac Shelton. Mac started his career in private credit where he was investing in properties on the side prior to starting Sweetbay Capital. And now that he's running Sweetbay Capital, it took off in 2021 when they bought their first property, focusing on value add multifamily in the Virginias and Carolinas in the 50 to 200 unit range. Mac, welcome to CRE Insights.
Thanks for having me, Connor.
Yeah, man, excited to have you on. As far as where you guys are at today, it seems like you have started this up a couple of years ago, and so you guys are in that early stage of validating the asset class and beginning to get a couple of big wins on the books to show investors. So show me, break us down what that portfolio looks like for you today, and what it is that you're seeing in the market out there.
Sure. So as you mentioned, we focus on Virginia and the Carolinas. We currently own 3 properties in Roanoke, Virginia, and 1 in Winston-Salem, North Carolina. We're always looking really anywhere in those 3 states within commuting distance of a population center of at least 100,000 people, but have so far had more success in markets that are less liquid, less competitive. We haven't been able to make, as we mentioned before the podcast, we've had a hard time making the numbers work in markets like Raleigh and Charlotte so far. We're getting closer now than we were 2 or 3 years ago when the market was really peaking, but we've had more success in markets where cap rates are a little higher, and often there's more opportunity to improve operations given kind of who's owning properties in those markets. But as far as the portfolio, it's currently 191 units across those 4 properties.
Nice. How did you get into this business in the first place? Like take us back in terms of I think you were doing some student housing stuff on the side at your job. Like, why real estate? You come from a real estate background, real estate family, anything like that?
No real estate background, really. It started in college. So I was in a group my senior year that managed like a student-run investment fund, and small dollars, donor money. Nobody really cared about the returns besides us, but we did the CFA Institute Research Challenge, and we were assigned Highwoods Properties, which is one of the largest office REITs in the country. And that was really the first exposure I had to real estate. And what I appreciated about it was when I'd done financial models on operating businesses before that, it always kind of felt like I was just sticking my finger in the air when it came to volume and pricing projections and things that for a lot of businesses are very difficult to accurately forecast. Whereas with Highwoods, it was pretty simple to take the square footage of their portfolio, break it down by submarket and by class, ABC, whatever, and figure out a market cap rate for those assets and value the portfolio in a very black and white way that was easy to understand and easy to be confident in. And that kind of got me started thinking about real estate. And then after college, I bought my first house that I lived in a room, rented a couple of rooms out. Pretty soon after that, my first job, the company got sold and everybody got laid off, and I moved out to California and rented that place out full time. And it was sort of the light bulb moment of the potential, right? And so I started looking for more properties, ended up buying my second property, my first real investment property that I was never going to live in Columbia, South Carolina in 2019. And that property kind of was the beginning of Sweetbay, even though I didn't know it at the time, right? My current partner and I ended up buying 4 more of those units in the same development over the next couple of years. Ultimately, that led to an opportunity to buy a portfolio of those units, and that was Sweetbay's first deal, which was the Retreat Columbia. We bought that in 2021 while still working in corporate private equity. So, our day jobs were buying companies as opposed to real estate, but we were just doing that on the side and had an opportunity to buy a portfolio that was too big for us to take down alone. So we put a little pitch deck together and raised some money, and realized after that fundraise that we could have raised a lot more than we needed to for that deal. And that encouraged us to go bigger on the next one, and it kind of, spiraled from there.
Yeah, it's cool to hear you describe the light bulb moment when you bought your first property, you rented it out, and you're like, oh, they're still paying rent, and I'm not really doing anything. And don't get me wrong, like, of course, there are the management headaches that can come up from time to time. And so it's never as easy as it seems. But the moment that you realize that you can start getting paid for something that you're not actively managing is a really good feeling. So I can definitely relate to that. Um, that first deal that you just described there, if I'm correct in saying it was a massive win. You held it for 15 months. Can you share some of the numbers that you guys saw on that deal and how that penciled out?
Yeah, so it was a small deal, but it was a really exceptional return. I hope we have more deals like that. It's we would be remiss to pretend like it was all us, right? We definitely timed it right and got lucky on the exit, but we also bought it right. And that the one thing that made it so easy to raise the money in that deal was we'd already owned 5 other properties just like those ones for 2 years and seen the performance, right? So the first one I bought, I modeled it out and did the best I could, but I'd never done it before. I didn't know if I was going to be completely off, really, right until I did it, and I ended up beating my projections on that first house, and that really gave us the confidence to keep going, and it gave our investors the confidence because we could say, like, look at the ones we've already owned, right? If they're going to do the same
Yeah,
thing these ones
like
did, and here's
like
the
we've done this.
yeah, we bought it at. I mean, the reason we were able to get the deal we did is because we bought it from the founders of the development company that built it, and it was their second development when they first built it back in 2008. They're now one of the big. I think they're the largest student housing developer in the country, right? So to these guys, this deal was a rounding error, right? To us, it was how we got started,
It
and
was
so they
everything.
really were almost price agnostic. They just wanted somebody that was going to close, and we had closed every deal we'd ever put under contract with the broker that sold us that. We still closed every deal we put under contract, and that allowed us to get it at, I would say, probably a 7 or 8% discount to what was market at the time for those units, which equated to roughly a 10% cap rate. And these weren't value add properties, right? It wasn't like it was a 10% cap rate because they were falling apart or, had occupancy issues or delinquency issues. They just wanted to move it quickly. And they were 100% occupied at the time. The development actually had been between 98 and 100% occupied since it opened, except for one little blip that was because of an investor that tried to self manage. But um, it was really just a kind of a no brainer on paper. And then one thing that also encouraged us to lean in on that one is just that at the time in 2021, we'd seen prices shoot up at every other SEC school, basically, and it hadn't happened in Columbia yet. And we didn't know when or even if it would happen, but there was a pretty good chance it was going to, considering it happened everywhere else, right? And it did. It happened about, I don't know, 3 to 6 months after we closed that deal, which is why I said we got a little lucky on timing, but we did expect something to happen there. And so we we ended up trading out 2 of the smaller units. So it was a portfolio of two, three, 2, 3, and 4 bedrooms initially. We didn't really want the 2 bedroom. Basically, the bigger the units were in the retreat, the better the cap rates were because values had been limited for a long time by appraisals, and the appraisals
Mhm.
were based on square footage and sales comps. The 5 bedrooms didn't have that many more square feet than the 3 bedrooms or even the 2 bedrooms. They had, more bedrooms and students, so you charge by the bed, right?
Sure.
And we like I said, we didn't really want the 2 bed for that reason, but we needed it to get the portfolio. We actually had it under contract to sell at a 25% profit before we closed on the portfolio purchase. So we flipped out of that very quickly and 1031 the proceeds into a 5 bedroom, which required no additional equity because we negotiated a arrangement with our lender where we basically had a committed credit facility on top of our loan at closing, and we just used that to finance the part of the purchase that wasn't covered by the proceeds.
Can you break it down from a number standpoint, right? So okay, so am I right in saying it was 11 units when you first bought it, and then you
It
added two
was
more, right?
yeah, it was 11 houses, right? So it
Mhm.
depends on how you look at it, and it depends on who we're talking to, kind of how, I mean, you could make the case that it was, I think, 40 something units. If you did it by the bedroom, I'd have to check the
Sure.
exact number, but they had at least 40 individual tenants and individual leases, right?
Understood.
And it
Okay.
ran like an apartment complex, but they're all single family homes with a small yard and a porch, and they're not connected, right? But they have shared amenities, and the HOA for the community was also the property manager. So it kind of was a hybrid, situation.
So you added two more to that portfolio prior to selling it, right?
We added in the sense that we traded out. So we bought
Right.
two
Okay.
other properties, right? We sold that 2 bedroom and bought a 5 bedroom. And then a few months later, we sold a 3 bedroom and bought a 4 bedroom.
Cool. So how much did you pay if you're comfortable saying for
Yeah, I don't
the
mind.
portfolio at the beginning?
We paid 1.9 million
Okay.
basically. It was like 1.8 and change, 1.87, I think.
Cool. And so how does that work as far as like debt goes? Like, are you going to the local bank and saying, all right, I need, it's 1.8, I need 1.5, 1.2. Like, what are they willing to lend at the time that you were putting that under contract?
So a lot more than they are today. And
Yeah.
that was mainly because of interest rates, right? So
Hmm.
the DSCR going in on this deal was close to 2. It was
That's
a
crazy.
no-brainer for
Yeah.
the lender because we were buying at a 10 cap, and
Yeah.
rates were at the time, our rate on that loan was 4.5%. So,
Yeah.
and it's 30-year debt. Now it was full recourse, it was a bank loan, but what we did was basically go to, we went the group that I had used, and I think my partner had also used for all of our individual purchases down there and for the lending, couldn't do a loan this size. I couldn't do portfolio financing with this, right? So we both knew a few other owners of, you know, 5 or 10 units a piece in the same development. And so we just called around to figure out who liked their lender and who didn't.
Hmm.
And we found that used to be Bank of the Ozarks, now it's called Bank OZK, was the most competitive. And the biggest benefit to that loan, the rate was good, but really in 2021, 4.5 wasn't anything special. Um, the biggest benefit to that loan was the fact that they were willing to commit additional dollars as long as we met certain thresholds in the next purchase. And that's something that we had done a lot in our private equity careers, right? Where you'll have something called a delayed draw term loan facility, or DDTL, and you'll go out and buy what you refer to as a platform acquisition, where you buy a big company that you plan on using to do a lot of smaller acquisitions to tuck in, because you get arbitrage between the multiples on like a larger company is worth more per dollar of
Hmm.
earnings than a smaller company, right? Kind of like
Hmm.
larger apartment complexes typically trade at lower cap rates than smaller ones. So you could arbitrage that multiple without putting any additional equity in if you were buying the smaller company, at a lower multiple than your leverage multiple on the bigger company, because to your lender, your loan to value is still going down, even though you're borrowing more money, because you're adding more value than you're borrowing, right? That
Sure.
was kind
Sure.
of how it worked with this. So we as long as we maintained our DSCR and our leverage thresholds from closing, we pretty much, I think there was a limit on how much we could spend, but until we got to that point, which we never got to, it was kind of carte blanche, right? And that made a big difference in terms of being able to add units to the portfolio, because again, we didn't have to put any additional equity. We just did 1031s and kept borrowing more money, and it allowed us to add unit count while trading out at some of the highest sale prices that the retreat had seen, and buying at the time still discounts to market.
How much investor capital did you have to raise for that deal?
The total equity check was 405,000. We did 100 of that, and the investors did 305.
And given that it's your first year, I love that you told the story around, you had done deals like this on your own accord, on your own dime. And so you're
Yep.
able to turn to somebody with a pitch deck and you say, I need 305,000, I think is what you said. I need 300,000 plus. And I've done this deal. I know the risks. Here's what we're projecting. Like, sign up here. Is this something like just getting really tactical here, because you come from a private equity background? Like, are you thinking, okay, let's go out to different family offices, or are you saying let's go to the family and try to find the uncles and the dads and the grandmas and stuff like that, and just say 10K checks, 25K checks? Like, what was the process for your first deal, and how has that maybe
Yeah.
evolved as you guys have done a couple more?
So I would say we're still in this stage of our of sweet base growth, but certainly on that first deal, our perspective was this deal is not big enough to really make that much money for us, right? Even if we charge the same fee structure we charge today, even with the 76% IRR, it still wouldn't have been a windfall for us, right? But it was an opportunity to, one, prove out to ourselves that this was a viable business strategy that we could eventually take full time, and two, start building a track record, right? So we've intention and we look we there's a lot of people that started around the same time we did that have grown a lot faster than we have, and that's intentional because we are very focused on growing profitably and growing prudently, and not, there's also a lot of people that started maybe a couple years before us that now wish they didn't own 10,000 plus units because they don't really know what they're doing and they're in trouble as a result, right? We don't want to be in that position, and we intentionally have gone a little bigger on each deal because our goal right now is to build an impeccable track record there's really no argument as to why you wouldn't invest with Sweetbay 5 years down the line, because every deal we do, we're going to beat the projections that we told you, right? That's the goal right now. And none of the deals we've done so far, our biggest one's 90 units. Even that one, it's not big enough for my partner and I to, really make much progress towards, retiring or anything like that, right? It's just, so um that was the goal there, and we didn't charge any promote. We had a 3% acquisition fee up front. That was the only, and we charged a 3% acquisition fee on every deal. So we charged it on the initial closing and then on the two follow-on acquisitions. But those were the only GP economics in that deal, right? And we just took it as equity as opposed to cash. And we're glad we did, because it's worth a lot more than it, was if we take it in cash. And we're actually about to do our second 1031 with that same chunk of equity. But I guess the gist of it is just to say that it was a track record building exercise more so than a money making exercise. And to answer your question that I totally just talked right past, we, as part of trying to prove out to ourselves whether or not this was a viable business strategy, we intentionally did not raise money from family members, because there's only so much money you can raise from your family, at least if, unless you come from a lot more money than we do, right? So we knew if we were going to be able to scale this, we were going to have to be able to raise money from people that were only investing in the deal because of the merits of the deal and because of the merits of our experience, right? And it wasn't, a $300,000 check is not worth the time for most family offices or funds. So it was individuals, and a lot of our equity has still come from individuals, but our backgrounds in private equity and investment banking have given us some really good connections to people with capital and people that understand the types of investments that we're doing. And we've leveraged that as best we can so far, as far as raising equity.
Well, they've got to be thrilled with y'all, especially if you go from deal one, 77% IRR, 2x equity multiple, 1031 that into another deal, which it sounds like, I think I heard you comment that you might be 1031ing that again. I don't know.
Trying to. We got to find a down leg, right? So our second deal, Langdon and Briskwood, that was in Roanoke, Virginia. We still own both of those properties, but Briskwood is under contract to sell this month. And I don't want to jinx it, so I won't talk about returns, but it's gonna be good. And that one we plan on 1031ing into something else if we can find a replacement property in 45 days, right? That's the catch with 1031s is we've been looking just as hard for our next deal since the last time we signed an LOI was December, right? So I don't know how good the odds are that that's going to happen in a 45-day window when it hasn't happened in a 250-day window. But it did last time, right? And that actually was another lucky timing thing there, right? Where we happened to, we actually reached out to the guys that bought the retreat deal from us. I had reached out to because we were trying to learn what the hell we were doing, right? And in the, syndication world. And I'd been referred to one of these guys by another sponsor to help us raise equity for a deal that was a lot larger than the retreat. And we ended up not doing that deal, but I got to know the guy and mentioned that we were thinking about selling this portfolio. And a couple months later, he called me and made us an offer. And I think we had just signed the LOI for Langdon and Briskwood. So the timing was just perfect, right? We'll see if that happens again, but that is the goal. And we do, I mean, we put in a best and final offer 2 days ago. We've got some other opportunities in the pipeline that are, I'd say, I don't know if they're high probability, but they're higher probability than 90% of the stuff that we look at, So it could happen. If it doesn't, then, at least we're into the long-term capital gains piece of the taxes. And it's hard to complain about paying taxes on profits at the end of the day. It's better than not paying taxes because you lost money.
Somehow every real estate investor finds a way though.
Yeah.
but that makes a ton of sense. As far as like the deal size goes, I think something that you just said earlier was like you want to prove a track record of incredible returns. Love that. As far as like the types of deals you're doing, right? The first deal was 1.8 million. Sounds like maybe you guys have done a couple bigger ones now at this point in the 90 unit range and so on and so forth. I think typically the larger you go and the more institutional you go, just by the nature of the competition and what people are willing to pay, you're not going to be hitting, and please push back if you think otherwise, but you're probably not going to be.
I know what you're going to say, and you're right.
The 77% IRRs, the 2x equity multiples, right? And so for you, from a preference standpoint, like let's say it's 2034 and you're looking back on this podcast 10 years later, are you more excited about doing these $1, $2, $3 million deals and getting awesome equity returns and trying to find as many of those opportunities as possible? Or is it more exciting for you the idea of let me build this 100, 500, $1 billion assets under management vehicle machine and settle for the 8% prefs or whatever that looks like, what are the 15% IRRs, because I can deploy a lot more capital and I can run that game at a large scale. Like what's getting you excited right now?
So I think it's it's kind of a tale as old as investment management, that in order to attract capital, you have to generate alpha in the beginning, right? And look, you should always be generating alpha, but what that means changes as your AUM, right? Blackstone is not shooting for 76% IRRs, right? And they're making more money than we ever will, right? We do want to grow the assets under management, the deal size, because for one, we don't want to do everything ourselves forever. And in order to have the luxury of overhead, we need to do bigger deals, right? At the same time, we're trying to grow at a pace where we don't ever have to worry about whether we're going to be able to raise the equity for a deal. The last thing that I want to do is go out and put some $40 million deal under contract and then have to back out and burn our reputation with brokers and lose a bunch of dead deal costs because we couldn't raise the equity because we bid off more than we could chew, right? Actually, that's not the last thing I want to do. The last thing I want to do is figure out a way to raise the equity and then screw it up because I'm not qualified yet to manage that asset, right? So we're trying to learn as we grow and grow as we learn, and also grow in a way that allows our track record to kind of continue compounding on itself. You know what I mean? So the second deal, so the first deal, like I mentioned, was about 1.9 million. Second deal was 3.25. Third was 7.25. Actually, the fourth one was a little smaller than the third. It was 4.2-ish. But right now we're trying to, ideally we'd like our next deal to be between 10 and 20 million. And we would do smaller. We put in a bid on a deal this week that'll be less than 6 million, but it really has to have some sort of strategic value. Like that deal is in a market we'd like to get into. It's affordable. It's a little different than something we've done before, and it's kind of in a space we want to get more involved in. And if it was just a, a deal like Langdon and Briskwood, I don't think we would really bid on it right now. Because
Mhm.
it just doesn't really. It's not really worth the effort for us anymore. So we're targeting kind of 10 to 20 million for the next one. Maybe eventually we get above that. I think for the foreseeable future, we like the idea of buying deals where when we're going in, you're only going to be able to get like Freddie SBL debt, for example, like smaller balance debt, right? Where it's not as attractive, right? The interest rates are higher, nothing about it is as attractive. But when we sell it, it'll support conventional agency debt,
Mhm.
right?
Mhm.
Because that right there will give you a 25 to 50 bip jump on your, or discount premium, whatever, on your exit cap rate, right? So and that's not going to last forever, because eventually we want to be buying deals that are already at that stage. But for right now, we like that, and I think Mount Pleasant Villas should end up in that category when we go to sell it.
And you guys want to play the PE flip game, right? Because I think there's effectively two ways to play the real estate game. It's I want to buy it. I'm going to buy it here. I'm going to sell it for 5 years. I'm going to get some kind of basis point spread in terms of what I'm buying for, what I'm selling for, or you have some value add there. The other way is the way more boring way, arguably, but we're gonna buy, it's gonna be a great basis, and we're just gonna hold for a long freaking time, and make that 20, 30 years down the line, everything works out.
Yeah.
You guys are pretty content, or not, I don't know if content's the right word, like you guys are pretty adamant on playing the first one where you want to realize that return and keep that snowball rolling with the new deals. Is that right?
It's a little of both. In the beginning, I think it's hard to start a business like this where I mean, pretty much all of our compensation is back weighted at exit, right?
Mhm.
Unless you already have a ton of liquidity, you really can't run a business like this in a way where you're not getting paid for 10, 15, 20 years, right? Because by the
You
time
and
you
your
get
partner
there,
need
it's
to
too late.
eat.
You're already, you're already done, or you're already broke. So,
Yeah.
and you can't hire staff. You can't, so in the beginning, and this is actually something that another sponsor told us early on, and it really made a big difference in our ability to actually have a viable business out of this. The retreat we underwrote as a 10-year hold. And I remember running this past another sponsor a few months after we closed, and he's like, "What the hell were you thinking underwriting a 10-year hold? Like, you're not going to be able to put this on your track record for 10 years because you're not going to exit for 10 years. You're not going to get, well, we didn't have promotes, so we didn't really care about that piece of it, but you're not going to get the cash back out to put into the next deal. And your investors are not going to get the cash back out. So they're going to give you less cash in the next deal, right? You can't, the flywheel doesn't work in the beginning with those longer term holds. That being said, I do think that, I mean, it depends, right? It depends on your goals and your age and a lot of different things. For people my age and probably your age, IRR really should be king, right? Because you need to grow wealth faster until you're at a point where you're kind of in preserve and harvest mode, right? And a lot of our investors are already there, and for them, a longer term hold does make a lot of sense. It actually, I think, real estate in general is better disposed towards that kind of strategy than a quick flip strategy. So what we'd like to do is have a balance.
Mhm.
The challenge is we've been very well oversubscribed on every equity raise so far, doing things this way, right? We've never done it the other way. And so just like on our first deal, we won't know really if we can raise the equity until we do it, right?
Yeah.
Because we've never done it with that kind of structure. And it's also hard to come up with a structure that has the same sort of alignment and win-win, economics for the GP and the LP when you're holding for 10 plus years.
Yeah.
Because if you base it on IRR, the GP is not going to make any money. And if you try to take some kind of a split on the cash flow, the LP is not going to make any money for the first few years. So it's just more challenging to structure a deal in a mutually beneficial way on those longer term holds. but we definitely want to figure out how to make it work because it does. We want to have some balance in the portfolio,
Well,
and
and that's
having
the
scale helps make everything like it makes your operations more efficient. We are certainly operating at a lower cost per door in Roanoke since buying Mount Pleasant than we were when we only owned. Now we have 131 units in Roanoke. When we had 41 units, we were probably spending 25% more per unit on OpEx in a year because we didn't have any scale, right? When
yeah.
you sell everything, you don't have scale for as long. If you hold them longer, you can have a bigger portfolio and benefit from those efficiencies.
Yeah, nobody, no sponsor wants to explain to the LP why they need to buy groceries and pay rent and why
Yeah.
why they need their fees in the early days, right? But it's something that we've noticed a lot too. Like all the deals that we've done are around the $1 million mark, honestly. And like none of them, this is part of the reason why we haven't raised outside capital. None of them pencil if we need to raise outside capital. And
Right.
so that's part of the reason people tend to go bigger in their future deals is because they can afford to pay themselves, pay an LP. You talked about it's hard to structure things like that. When I heard it sounded like the only fee you took on your first deal is the 3% acquisition fee, which sounds kind of wild, if that's true. And I heard you right there because no
Yeah, that's right.
management
On the
fee,
first deal.
no promote. Okay, so how do fees work today?
So today we charge a 2% acquisition fee. We
Mhm.
charge a 2% asset management fee on effective gross income or revenue, right?
Mhm.
And we charge a 1% disposition fee on the exit sale price and refinancing fee on the gross loan proceeds of the refinance. We have not done a refinance yet. We're about to do our first one probably, but um, so that's the fee structure. And then as far as the promote, we have a 7% hurdle rate, which everybody calls a preferred return. It's not really a preferred return. I don't really know why in real estate it's called a preferred return when it's not really preferred. But anyway, the hurdle rate. And above that hurdle rate, we charge a 30% split. If we get above a 16%, and this is IRR, right? So it's
Mhm.
cumulatively compound. Well, I guess cumulative compounding and all that. And we don't get any promote until we've returned all of the investors' equity and all of their accrued pref or hurdle rate, right? Because it's an IRR. So your
Yeah.
IRR is, you don't hit zero until you get all the money back. So that's the first tier. If we get above a 16% net IRR after all the fees and after all that first tier promote, then we get 50% of the profits above that. But you'd
Cool.
have to be at, a 20% plus gross IRR for that to happen.
Yeah, I mean, I think that's awesome. I don't know why I feel like there's so many LPs and honestly, just from the show, if you listen to any of the previous content that we've put out, I've heard more 50-50 splits. And especially like even with people who have higher prefs, like there are people who are doing 60-40 split favor of the GP because they have, a 10% pref or whatever.
Yeah.
And so yeah, I personally think it's super fine to do that, especially when you're raising a smaller amount of capital because of that
Yes.
you are now incredibly motivated to get the highest disposition price that you can possibly find for
Yep.
this asset, which I think it puts everyone to be very well aligned.
Yeah. I mean, there is a catch to it, right? In that IRR, I'm sure you've heard people say, right, you can't eat IRR, and it does incentivize you as a GP to sell faster than you planned, to refinance whether or not it really makes business sense because you get cash back earlier, right? And in a more intentionally misleading scenario, like I think a lot of GPs are doing today, it incentivizes you to do stuff like raise cash at closing just to pay a pref that you promised investors out of their own cash, which is ridiculous. But it's the kind of stuff that incentivizes, right? So we will probably end up changing that structure a little bit as we go up market in terms of deal size because you can't you can't really be you can't have the most conservative underwriting, treat a 14 or 15% net IRR as if it's a zero in terms of like whether it's a win or a loss, and have a 7% pref and a 30% profit split and ever buy a deal above 100 units. We're figuring that out, right? It's very difficult once you get to that stage. And so for bigger deals, we're probably going to change a little bit. It'll probably be something like a 7.5 hurdle and a 25% split.
Mhm.
Um, but and we'd also like to figure out some way to maybe there's like an MOIC or an equity multiple threshold before you get certain promotes or whatever. One thing that we've started building in that I think is a good it I think it can be a little confusing and maybe can lead to skepticism, I guess, from LPs at some depending on how it's done. But one thing I think really helps solve this problem is the idea of crystallization. So I don't know if you've talked about that with anybody before, but
Mm-mm.
it's I think becoming more common. And basically the way that works is you say, okay, like the deal we've got in Roanoke right now, the one we're selling is an older property. It's smaller. I think everybody's happy to just move on. The other one we bought in that portfolio is like my favorite property I've ever owned. And the investors would like to hold it. We would like to hold it. But at the end of the day, it's like, look, guys, if we're going to keep raising money, we need to be able to show a track record of solid IRRs, right? Yeah, we get paid on IRR, but really, even more important, it's only a $3.5 million deal. Like, it's not about the money. It's about the fact that we want our first deal to be that 76 and our second deal to be, 40, 50, whatever IRR so that we can continue to raise money. How do we bridge this gap? And one way that we have have started to prepare to move around that in future operating agreements is to bake in a crystallization provision whereby once you hit a certain time threshold, whether it's a year or 2 years, and once you basically hit your pro forma, right, you've got X percentage of units leased at whatever rate you said it was going to be, then the sponsor has the option to go to the LPs and say, hey, look, we got this POV. Here's the value. Here's what that implies for exit proceeds. Here's what that implies for the IRR if we sold today. And here's what that implies for our promote. We'd like to take that percentage and convert it to equity right now and hold this for as long as you guys want, right? And they have to approve that, or they have, we can go out and get more appraisals or BOVs to kind of make sure everybody's comfortable with the valuation. But ultimately, it gives us more flexibility to still be able to buy groceries without having to just sell every great deal as soon as we hit our pro forma.
Yeah, it also just gives you guys the same incentives, right? Okay, you want to do more deals and raise more money in the future. In order to do that, you need to figure out how to show people that you are doing your job well. And from their
Right.
standpoint, they want the good returns that you're able to generate for them. So
Right.
it puts you guys very much on the same page.
Yeah.
That's great. Um, the last thing that I've got here, and take this in whatever way you will, whether it's around um, asset selection, deal size, how to find investors, how to manage properties. Do you have any general advice for where you were maybe a couple of years ago, coming in as a first time like sponsor, first time real estate investor, and like getting ready to get into this kind of real estate private equity world? Because just from talking to you today, your investment banking and private equity background very clearly shows through, right? Like you're talking in a way that's not the traditional guy of I can find off market properties and I can lease them up and sell them good. You're definitely approaching this from a more finance background.
Mhm.
Um, any advice that either you think you've just done a really good job with that you would give to other people, or something that you struggled with that you would want to have known early on?
Well, look, I think there's certainly benefits to our backgrounds relative to other sponsors. At the same time, we have a big disadvantage in the fact that neither one of us have ever worked for an institutional real estate company, right? Whether it was a brokerage or a lender or an investment shop. And that you have to be very humble and aware of all the stuff that you don't know, right? And you have to seek out advice from people that do. You have to not take risks that you don't understand, right? And you got to do more diligence up front than people that already know all the stuff that you don't yet, right? So that I think that's something that even people that do have real estate experience, I think the whole market would benefit if there was a little more of that, kind of prudence and caution and diligence going around. But as far as advice, it kind of depends on what stage. I mean, after I'd say my second property, I kind of got comfortable with the idea of like, okay, rates are maybe they stay this low forever, maybe they go lower. Probably not going to happen. Like it was as low as they'd ever been in my lifetime, right? And I was like, I can get 30-year fixed rate debt at less than 3%. I should be buying everything I can get my
Everything.
hands on, you know?
Yeah.
And that's what I did, right? I mean, when I was 24, I probably owed 4 or 5 times more than my net worth, you know? Which is, you know, some people call that. I kind of joke sometimes, like if you're in your 20s and have 800 credit score, you're not trying hard enough, you know? I think that's different today because rates are so much higher than they were, you know, but like we're all playing this currency debasement arbitrage game with whether it's private equity, hedge funds, venture capital, real estate, certainly with hard assets like real estate. At the end of the day, you know, as long as we keep, as long as we maintain the kind of fiscal policy that we've had and monetary policy we've had since, at least since I was born, owning stuff like this is, unless you buy it at the wrong time and over leverage and pay too much, in the long run, you're probably going to be okay, you know, and you're probably going to be better off than holding cash, you know? So I'd say don't be stupid, but also don't be so overly analytical and cautious that you never buy anything, right? Even if, I mean, look, when after I closed on my first house, I think I had like $5 or $10 left, right, in my checking account. Like that was, you know, I mean, I got my
Right.
loan with an offer letter for my first job. I hadn't gotten a paycheck yet, you know, but
That's crazy.
you gotta be willing to take, like, everybody that I know that didn't already start out crazy wealthy that's gotten there took risks like that, and you have to be willing to, but you've also got to understand how serious the consequences are of that kind of thing going against you, right? And it becomes even more serious once you involve other people's money, you know. um so it's just you gotta be aware of what you don't know, aware of your limitations, but also have the sort of killer instinct to see an opportunity and go for it, you know, and not be so worried about the risk that you never really take any.
Yeah, I think the tough part in the beginning is understanding what a killer opportunity is, right? Like,
Yeah.
I don't know, for us personally, the first deal that we ever did, in hindsight, awesome deal. And
Yeah.
little numbers too, for what it's worth, right? Like, I mean, we bought it for 400. It reappraised for 1.2 like 13 months later, and we pulled out all of our money plus several hundred thousand more, right? Like,
Yeah.
looking back, right? And again, just a caveat, like these are small numbers, but looking back, killer deal. At the time, we're looking at this thing, we're like, we've just never done it before. And so being able to have that conviction and feel good about it and trust your gut, I think is kind of the only way that you can jump in. And I think
Yeah.
that's why a lot of people would say, just do any deal. It doesn't have to be the best deal in the world because it starts to build the confidence to make you realize that you can do bigger and better deals in the future.
Yep. Definitely. But again, you know, the way to, there's two ways to have that confidence, right? One is to just be overconfident, and one is to do your diligence, you know?
Yeah.
And if you do your diligence and it pencils, do it, right? I mean, that's one thing too that I think early on, I mean, I certainly was this way. Early on, people are afraid to make those kind of decisions, is that now if we can get a deal to pencil, you were talking earlier about settling for a 15% IRR. That's what we underwrite to, right? Like
Mhm.
on all these deals, you know, I mean, the
Mhm.
retreat we underwrote to a 19 because there was no GP economics basically, right? But on all our deals now, like we're underwriting to a 14 to 15% net IRR on our investors. Now, I
Mhm.
hope we beat that on all of them. I think we will beat that on all of them. But if I find a deal today, especially if it's in that 10 to $20 million range that we're really targeting for the next one, that just kisses that 15% IRR. It doesn't even have to be like, I'm ecstatic because
Yeah.
that happens maybe once every 18 months, you know?
Yeah.
Like it's
Yeah.
really, you know, it's so rare that if you can get it to pencil and your underwriting is sound, you're probably going to be fine, you know?
Mhm.
But I think early on, people think that more deals are going to pencil than do, and they're, you know, disappointed when they realize how hard this job really is, and they think they need more return than is really realistic, and they just want, you know. And I did the same thing from 2017 on my first deal to 2019. I should have bought every single deal that I offered on, and I should have just paid what they asked instead of trying to get cute, right? Because I would have doubled my money at least on all of them in the meantime. But I didn't, and you know, I was too cautious.
Completely agreed, Mac. Mac, this is great. I think people are going to find this to be really valuable. If they want to check out what you are working on, if they want to follow you, if they want to learn from you, what is the best place for them to go to do that?
Our best place would be our website. It's www.sweetbay-capital.com. And you can also find me at LinkedIn under Mac Shelton.
Cool, man. All right, we will link to all of that below. And thank you for coming on today's show.
Yeah, thanks for having me. Enjoyed it.